Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Want to talk about today Fed Bullard. He's at it again, came out with some pretty hawkish comments. We saw a reaction in the equity markets. Equity sold off, bonds sold off, especially the short end, the 2 year, causing the yield curve to invert even more. I think it went around, I could be mistaken, but if you check the 10 to 2 year spread, it went around about 0.69%, inverting even deeper. So, what caused this inversion, right? What is happening with the reaction towards what Bullard said, especially the hawkish comments? Now, let's backtrack a little bit before we talk about Fed Bullard. A lot of the Fed members have been coming out and saying that yes, the last inflation report that we got, which was lower than expected, but still at 7.7%, which is high, doesn't mean we're going to declare victory on inflation. Doesn't mean that they're going to stop raising rates and they're going to call it victory, right? Doesn't mean that inflation is done with. They still have a long way to go. And a lot of Fed members did say that. They still need to fight inflation. They still need to see more data in order to determine where inflation is going and what does it mean going forward and what to do with the interest rates. Now, sure, the pace, the speed, doing the 50, 75 basis point, maybe that is coming to an end. Probably go towards 25 basis points. But we'll see. We still got CPI data in December, still got CPI data, January, February, all of next year to analyze how the data is coming out. If those data points continue to be higher and they end up moving higher, then definitely forget the 25 basis point rate hikes or the 50 basis point. We're back to jumbo rate hikes again. But let's go with the narrative that inflation has peaked. We're coming down slowly, but we're not done yet. Like the Fed said, like a lot of the FOMC members have come out and said that we still need to continue with our rate hikes. May not be as fast as what we did this year, but in 2023, we still need to get close to that 5% or above. Now, Fed Bullard came out today, said some pretty hawkish comments, and it's very important to understand what those comments are, what they mean, and it's very important to monitor those comments, especially when a lot of the Fed members will come out and hear what they have to say, especially during the next year and their views. So, Fed Bullard, mentioned, first of all, that the bottom line, the base of the interest rates should be around 5 to 5.25%. On top of that, he claims that current rates right now are not in restrictive territory. And he has a whole presentation that talks about this. And I'll link the presentation in the description for you. So you can take a look and you can read up on it. But in his presentation today, he talked a lot about the Taylor rule. So Bullard came out, talked about we're not in restrictive area. 5 to 5.25 would be the base area to be in terms of interest rates. But he talked a lot about this Taylor rule and say restrictive area would actually be if we follow the Taylor method. And the Taylor method basically suggests, especially in his presentation, it suggests that we would have to bring interest rates to 7% plus. Now, what does that mean in terms of inflation? Well, in order for the Taylor rule to work, you would have to have inflation below the interest rate. So the interest rates needs to be higher. So if you have interest rates higher than the inflation, then yes, the Taylor rule says that you can bring inflation lower as long as the interest rates are above the inflation rate. Now, if inflation rate's at 7.7%, does that mean we need to hit 8% in interest rates? Now, in his article, in his presentation, He says the restrictive area tends to be around that 7% level, 6 to 7%. Does that mean that inflation will come down to maybe around 6%, lower than 7%, somewhere around that area? So that if inflation is coming down to that level in 2023, then we can bring rates to 6 or 6.5 or 7%, which is explained in that presentation. So that means rates could continue to increase. Now, what if inflation doesn't come down? Still elevated at 7.7, 7.5, moves up to 7.8. Then what? Does that mean we take rates to 8%? What if inflation goes to 8, 8.5? Do we bring rates to 9%? Now, the Taylor rule was quite ignored or not really heavily talked about by Jerome Powell. It was discussed a couple of times, but it looked like they didn't want to follow that path. Now today, Bullard came out discussing about that. Makes you wonder, now having this whole presentation and saying that we're not in a restrictive area, then and the Taylor rule suggests that the 7% area would be the restrictive area. Does that mean things have changed? The communication among the FOMC members, have those changed? So we have to monitor this, see where this goes, see how the other Fed members talk about the Taylor rule, talk about, especially next year, where inflation is, where their minds are with interest rates. Definitely it's not going to stop. Definitely they said they're going to continue. They got to hit their target. But if they hit their target and they don't see much changing, they could still continue, and that could put up the next target of maybe 6% interest rates. And then from there, if things don't solve on its own, then 6.5, 7%, they'll start to slowly increase the heat and the pain and the tightening until maybe something breaks. And like I was saying previously, you're going to need that. There's going to, in order to bring inflation down, if we're unable to get the interest rate above the inflation rate, then there would need to be some sort of crack that eventually breaks. And there are already some cracks in the economy, but something to break heavily that will cause inflation to come down below or to their 2% target. And I think it's very likely to hit that, especially if you have a very severe recession. And you see this previously with 2008, 2000, previous recessions and crashes. When that happens, you do see the inflation rate come down. Now it's very interesting that Bullard came out with this presentations and presentation talked about it. It'll be interesting to see how the Fed members feel about this, if they mention it at all. It'll be interesting to see where data is in the coming months. Remember, we still have more data for December. We have an inflation report in December, January, February, all of next year, which will need to be monitored. And we'll see where inflation and data is, especially the growth data, especially because we saw retail sales just recently come in strong. Especially also the jobs number, the unemployment rate, they still seem to be doing fine. And job market seems to be robust. And the Fed has been mentioning also, they're not only focused on the inflation, but they're also focused on jobs. And if they can create that unemployment and those job losses, they're hoping that it's going to bring inflation lower, those wages lower as well. That's contributing to all of these higher inflation from their point of view. Now, their point of view is to create the job losses that will create the wages to slow down or stop, and then eventually cause the inflation to come down, especially if there's a lot of job losses, crashes, and then that's something to break to come in. Now, obviously, the Fed they want to do this very diligently. It does look like they are trying to engineer a recession and engineer a soft landing. Will we get a soft landing? We will see. But I think we're more likely to see a hard landing than a soft landing. and they don't want to bring things a little bit too much into, they don't want to tighten things too much where it looks like it's their fault. They want to do things in a very calm manner so people don't see it coming. But we can see it coming because we just monitor the communication from the Fed, from the data, from the interest rates, and see time by time over time that they are continuing to hike and hike and hike. And you're seeing it already with the big tech companies out there. Job losses already starting, right? This is just the beginning. This is just the beginning. Wait till we get more tighter in the economy. And it could be this may last until 2024 or 2025, or maybe, very short. It could be just 2023. Who knows? This is definitely we're in a very different time, especially with the pace of the rate hikes that we've done. I don't think we've ever done something like this in 1 year where we've risen 400 basis points in 1 year. Usually you see 400 basis point being, increased by the Fed over 5 years, and we're getting it in 1 year, right? The pace of that, the effects of that, how fast we tighten, we might see the effects of that. It might be delayed, but we might see the effects of that maybe next year. Who knows when, but we need to monitor all of this, especially after Fed Bullard's comment. So I thought those comments were pretty hawkish. Thought I would bring it out here and talk about them. Leave a comment below. Let me know your thoughts. Subscribe, hit the like button as well, and the bell notification button to be notified on the next videos. And I'll see you guys around. Cheers. Bye.